This is Walter Zimmermann at United ICAP with a special webcast on the outlook for natural gas prices. And below here are the main topics we'll be covering. What are they fighting over? Who's fighting over it? Where is the battlefield? What's the projected outcome? And what are the likely winners and losers? And you may wonder what the heck the Battle of Issus has to do with all of this. This is Alexander the Great fighting Darius in the Battle of Issus in 333 BC. This actually has some relevance. We'll be getting to that a little later on. This special report, or webcast, whatever you call it, grew out of a long-term wave count pattern that I suggested about a year ago when the market initially dipped. This is a monthly natural gas spot Henry Hub. When the market recovered from a dip below the long-term uptrend line, the wave count suggested that natural gas would rally back to $11 before breaking below $1.96. This was purely a technical outlook. But because it was also, at least a year ago, a rather outlandish outlook, I started poking around for the background story, if there was a background story that could align with natural gas making a rather dramatic recovery, despite the fact that everybody's thinking the flood, the tsunami of shale gas will continue to drown prices and prevent such an outrageous upside target from ever being achieved again in our lifetime. So this is the long-term wave count that was the inspiration for the material we'll be covering here this afternoon. And the title of this presentation, America, Fort or Port, has to do with LNG. There are a group of sectors in the U.S. economy that do not want any LNG exports whatsoever because they want to keep domestic prices low. So Fort America would be one in which the guns are aimed inside the country to prevent any LNG exports from getting outside the country. Port America refers to that sector of the U.S. economy that wants to maximize LNG exports, thereby allowing domestic prices to migrate up towards world levels. So this is the question. Do you prevent LNG exports or at least minimize them? Or do you maximize them? Just go full out and export as much as you can. The combatants in this debate are on the Port America side, big oil, the oil and gas lobby, natural resource industry. They want to export as much as possible. On the defensive, the Fort America side is manufacturing, the big business lobby. These are the combatants here. And I've purposefully drawn the battle lines to suggest the manufacturing lobby will be very outnumbered by the big oil lobby, and we'll be expanding on that side of this image later on. But for now, this is the controversy. Minimize exports or maximize them. These are the players, and this is what is at stake. My first question is, what is wrong with this picture? because there is something very wrong with this picture, and it's not the shape of the land masses. I've purposefully picked this chart where the country size is proportional to the percent of the world's population that lives there. And on top of this chart, I have labeled recent natural gas prices around the world. Japan and China, 15. Indonesia, 13. India, 12. Europe, 11. 11 being the average price that Germany paid in 2012. Northern Africa, 8. Well, that's because that's where Algeria is, exporting as much LNG as they possibly can. South America, 12. UK, 9. What's wrong with this picture is this price over here, US, 3, or 350, whatever the last price happens to be. It is way below world price levels. Why? Well, largely because, if not exclusively because, we have no capacity to export. Because it only takes, depending upon who you talk to, $5 to $6 to convert natural gas to LNG, and maybe 60 cents to send it all the way to Japan, and proportionally less to some of these other countries. So you take $3, even $4, you add $5 to $6 to that for the price of converting to LNG, and natural gas prices here are extremely competitive for these markets over here as LNG exports. And it's not just the numbers, it's the sheer mass of the population. China and India and Japan, and these are just huge groups of population. Even Indonesia is one of the fastest growing populations in the world. So it's a little misleading to just throw these numbers up on a regular world chart. I think it's a little bit more impressive to throw them up on the chart that shows just how many Chinese there are willing to pay up, the population of India willing to pay up, population of the Indonesian archipelago willing to pay up, and the relatively tiny little population of the U.S. sitting on extremely cheap gas. Now, there's another way of looking at this. If we go to a regular world map and LNG landed prices, and this is the most recent. This is as of March 2013. And it shows even higher values over here than the natural gas prices we looked at previously. So it's an even more dramatic difference here. So obviously, there's a heap of money to be made by exporting LNG. And that's obvious, but what I want to talk about a little bit is the effect this is likely to have on natural gas prices. And the effect it's likely to have is raising natural gas prices. Obviously, commodities flow from where they're cheap to where they're expensive. That's the universal truth of trading throughout the history of the world. When you move something from where it's cheap to where it's expensive, the price comes down proportionally where it's expensive, and the price rises proportionally where it was hitherto relatively cheap. So this is what the fight is all about. Do we allow unlimited quantities of LNG to be exported and thereby allow domestic prices to migrate up towards world levels? And when we say, do we allow it, I'll be talking a little bit about who exactly that we is. And if this doesn't drive home the point that there's a market for this, this drives home the point that that market will be growing, and rather dramatically. This is an Encana study using standard available numbers to show that this market, just for Asia, the export market for LNG, could grow quite dramatically, 25 BCF a day by 2020. So there's a market for LNG exports, and by all indications is that market will only be getting larger as a longer-term trend. Meanwhile, you have a bunch of manufacturers talking about cheap shale gas as the key to a renaissance of manufacturing in the U.S. Chemical producers abandoned the U.S. in droves. Cheap natural gas is luring them back. The question is, in light of what we've just seen about the global LNG market, how long will natural gas be cheap in the U.S.? And just to highlight some of the comments in this report, this text here is extracted from this report. Plummeting prices of natural gas can be used to make a number of products, blah, 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 luring key industries to the U.S. Construction of new chemical plants. Ethylene. Costs $300 to make a ton of ethylene in the U.S. Costs $1,700 to make it in Asia, and it costs $455 to make it in Saudi Arabia. So it's really, really cheap here in the U.S. And even if we think in terms of, well, will this be enough to close a manufacturing facility in China and bring it back to the U.S., there's one of the closing concluding remarks that they make here is the biggest difference cheap energy might make is to give existing U.S. factories a new reason not to close or move offshore. So this issue of do we export or not has huge repercussions for the U.S. manufacturing base and for U.S. jobs. Now, as to where all this gas is coming from, this is just a refresher. I'm sure this is not news. This is Baker Hughes existing wells. Natgas wells are in red. Crude oil wells are in blue. This is where all that Bakken crude is coming from. That's being shipped now to the East Coast as well as further south. But I think what's impressive is the degree to which these natural gas wells are just kind of scratching the surface of the available shale reservoirs. So contrast this chart, active wells, with this chart that shows the size of these fields, particularly Marcellus Shale, existing wells, the shale play here. So this is a huge issue. And one of the issues that comes up here that we're going to be talking about is the natural gas industry going to produce itself into bankruptcy? Do they want cheap gas? Can they afford to produce cheap gas? Is this are recent prices sustainable or even desirable? Or certainly, are they possible in terms of LNG exports? So this is the other side of the coin, that the shale gas that's currently being produced, well, there's a whole lot more of it where that came from. So that further complicates the issue here. And certainly, the natural gas producers are well aware of this situation, as evidenced by the collapse in the rig count, in the Natgas rotary rig count, which peaked around 1,600 rigs back in 2008 and has recently dropped almost to 400. That's quite a turnaround in just a few years. And it's unlikely that this rig count line is going to turn up anytime soon. We're contrasting it here against spot line on close weekly for natural gas. So clearly, the natural gas producers don't want cheap gas, they don't like it, and they're doing everything they can to rein in production. And we'll be seeing why a little later. Besides the price on the screen, the issue is at what price can they sustain shale gas production? Because by any account, there's going to be more and more of it. This is, I believe, it's not cited, but this, I believe, is an EIA chart. Now, when we get into the issue of LNG exports, this is a list of approved terminals, both import and export. Because if you remember, under Greenspan was pounding the drums for there's going to be a huge shortfall of natural gas in the U.S., and unless we immediately go out and build numerous LNG import facilities, the U.S. economy is going to hit a brick wall of dramatically high energy prices due to the impending shortfall in natural gas supplies. Of course, Greenspan turned out to be completely wrong about this, making him very consistent across pretty much all of his forecasts. But what concerns us now are the proposed potential LNG export facilities. And there are a ton of them on the drawing board. Now, maybe all of them don't get financing. Maybe some of them change their mind. Maybe the FERC doesn't allow all of them. But when you add up all of these proposed potential LNG export facilities, you go through this list and add up all the BCF per day, you get a number that we'll be looking at in a minute, and that we will be comparing to total consumption in BCF per day in the U.S., which has been pretty stable around 70. And projections for U.S. natural gas use, at least out to 2014, suggest this number may not change a whole lot. It's certainly been stable for a few years already. But what we want to do now is add up all the LNG export facilities that have been proposed, compare it to average daily demand here in the U.S., and this is what we get. Total USA nat gas consumption, 70 BCF per day. Total proposed LNG export capacity, 23 BCF per day. That's a big number. That's a big percent of demand. That's like 33% of demand. Already approved LNG capacity, whether export or import, is 14, but this number is not so useful because it includes some import facilities which are obviously not about to be built anytime soon. So for our purposes here, we're looking at this, 23 BCF total proposed LNG export facility, total consumption 70 BCF a day. Now, as I was putting the finishing touches on this proposal, on this presentation, an article came out in Bloomberg, and I'll just read you two of the sentences from it. This was dated February 22nd. As much as 10% of U.S. output, meaning output of natural gas, is likely to be earmarked for export as LNG by 2016, according to Goldman Sachs estimates. So Goldman is saying that this is actually going to happen and will be 10%. Remember we said this number was 30% of total demand. Well, they're saying by 2016, at least 10% of this will be functioning, operational, and exporting. And then a couple sentences later, while exporters from ExxonMobil Corp to BG Group are anticipating U.S. consent to LNG export facilities, Dow Chemical Company says it would drive prices higher and curb investment in new plants. Well, yeah, of course it'll drive prices higher. Of course it'll curb investment in new plants. The question is, who's going to have the upper hand here? The exporters, namely the producers, or those who would like to expand manufacturing in the U.S. or move it here from overseas? Who decides how much LNG export capability gets the go-ahead? It's the FERC. Now, before we get into who is the FERC, I wanted to speculate a little bit on how this natural gas average seasonal price cycle is likely to be impacted if 10 or 20 or 30% of the equivalent of average daily demand starts getting exported in terms of LNG. This is not going to be seasonal demand. This is going to be steady demand. These companies who are going to be engaged in taking advantage of this humongous gap are going to be steady, relentless buyers. And they can pay up quite a bit before it becomes uneconomical. If we take these prices here, you figure, okay, $5 to convert it, maybe $1 maximum to ship it. So you add $6 to this price, you get $9. Well, they basically could be paying $11 or $12 for natural gas in the U.S. and still make a tidy sum exporting it to Asia. But let's go back to where we were. And the next question is, what kind of impact would such a high level of exports have on natural gas seasonality? Well, I'd be willing to bet that it's going to abbreviate the seasonal decline from the preseason rally peak, as well as mute and abbreviate the seasonal decline from the May peak. In other words, this sell-off here, I suspect won't last as long, won't go as far. And the big money that's been made over the years in natural gas has been either buying a nice dip, buying into a nice sell-off for May into August and holding it for the run-up into November, or getting short in November and playing the seasonal decline. But for the users, for the end users, for those whom natural gas is a cost of doing business, if this decline is abbreviated in both duration and extent, and this decline is abbreviated in both duration and extent, then the low-hanging fruit of buying cheap nat gas on a seasonal basis is likely to be minimized. That low-hanging fruit is likely to be raised. Those buying opportunities are likely to be not so dramatic, reliable, and consistent as LNG export facilities come online one by one. Not to mention the overall increasing price, but the impact on the ability to buy dips is likely to be affected as well. Next question is, who's the FERC? Who are the decision makers that are in control over how many LNG export facilities are okayed and how quickly are they okayed? Well, the decision makers consist of a chairman and up to 5 commissioners who each have a term of 5 years, and they each have 1 vote. So it's a very, very small group of people that make this decision, that make all the big decisions at the FERC. And the question that occurred to me next is, where are previous FERC commissioners? Where have they gone? Well, without exception, they're either top executives at energy companies right now, or they are top lawyers at firms that represent energy companies. I could not find one ex-FERC commissioner that got a job at a manufacturing facility, that got a job at Dow Chemical, that got a job with the big business side of things. They all went to the big energy side of things, either as an executive or as a lawyer for energy companies. In fact, under Bush, it was almost a prerequisite to even be considered for a position at the FERC as a commissioner. You had to be an Enron booster. So pretty much, it's not an exaggeration to say that FERC commissioners come from the energy industry and then they go back to the energy industry when their 5-year terms are over. And this has to do with, and a related aspect here is lobbying activity, which is about, what, a $3 trillion industry here. The numbers are just ginormous. And this is all, you can go on this website and dig out this information. What we're concerned about are the relative size of the lobbies likely to bear on FERC decisions regarding how much LNG export capacity is okayed and how quickly are the various facilities given the go-ahead. Well, if we just sum up, this is all lobbying activity from 1998 to 2012. So you have a rather gigantic discrepancy here. Energy and natural resources is totally outnumbering manufacturing and distribution, assuming this is even a coherent group, which if you look at the composition, it's really not. The group of companies here is a lot more united and allied than the group of companies representing this sector. So the imbalance is even greater than the 4-to-1 ratio outlined here. Now, this gets back to the first page picture that we were looking at. So I'm going to have to go back here. Remember that 4-to-1, the energy industry outnumbering the manufacturing industry in terms of money available to lobby key issues. It's very, very difficult to find instances in human history where a group was outnumbered 4-to-1 and ended up winning. And one of those instances was when Alexander the Great took on the Persian Empire. At the Battle of Issus in 333, he was outnumbered, his army was outnumbered 5-to-1, and he squashed the Persian army. 2 years later, at the Battle of Gaugamela, he was outnumbered 4-to-1, and he triumphed again, dramatically. But we're not talking equals here. Alexander the Great had the first professional army in the world. He had the Greek phalanx. He combined that with a powerful cavalry. It was kind of like automatic weapons on the side of Alexander the Great versus bow and arrows on the side of the Persian Empire. In terms of absolute numbers, 4-to-1 odds, and he still won. That doesn't tell the whole story. It was not equal quality of power coming to bear. So when you try and find instances of a group being outnumbered at 4-to-1 and they still win, there's always more to the story. So when we go back here, what more to the story could there be? Unless the manufacturing sector starts getting from some free PR about reviving U.S. jobs, they're likely to be outspent in their efforts to minimize LNG export facilities, especially if the commissioners of the FERC come from energy companies and go back to energy companies, as has always been the case. And I don't mean to be skeptical or cynical here. It's just trying to evaluate the likely outcome. Here we break it down a little bit more, just looking at the year 2012. Again, this was all years 1998 to 2012. This is 2012 only. And we still find almost a 3-to-1 ratio of the energy and natural gas industry, the extent to which they are able to outspend manufacturing, distribution, and throwing in chemical and related manufacturing. So it's lopsided. It's nowhere near an equal contest. And there's a certain irony to all of this, because manufacturers who for decades were in a headlong rush to export jobs to lower paying overseas workers, now these same manufacturers want to prevent natural gas producers from exporting their gas to higher paying overseas consumers. Now that is just either an amazing irony or it's karmic justice. And in both cases, the rush to export and the rush to export jobs that has been the longer term trend, and the now rush to export natural gas, in both cases, U.S. manufacturing is the likely loser if we're talking about winners and losers. Now the next issue is, even setting aside the whole issue of LNG export capacity, there's a certain urban myth out there that shale natural gas can be produced with a profit at only $4. If you look through the website, that's kind of this common knowledge. But is it correct? Can these producers really turn a profit at $4 nat gas? Well, there was recently a study done that found that that $4 number is simply not true, because it doesn't include land costs. It doesn't include royalties. When you add in the true cost of producing natural gas out of shale, you get a number more than twice as high as $4. These are the numbers at which shale natural gas production is not a loss, because it includes land costs. And even if you take out land costs but add in drilling and other variable costs, you're still getting $5 to $7. So this $4 thing is just not real. I don't know where it came from. Maybe it was natural gas producers trying to hook up some long-term contracts. I know I can't speak to the origin of this $4 number, but that's what everybody's thinking, and it's just completely wrong. So in terms of cheap natural gas and the sustainability of cheap natural gas, it's an issue even without going to the whole question of LNG exports. Now, taking all that we've just seen and looking at the forward curve of natural gas from this perspective, we, I think, very quickly conclude that the forward curve of natural gas is not an accurate forecast. But then that's always the case. I have never, ever seen in 30 years of study a forward curve act as an accurate forecast of future prices. A forward curve is actually much more decided by the cost of money than the actual projection of future supply and demand. Now let's look at what the forward curve is saying here. This is the actually I should probably change this, make this blue so it's a little bit easier to see, but this line here is the forward curve of natural gas from the present out to 2026. And what it is saying is that by 2015, natural gas breaks above $4. By 2020, natural gas breaks above $5. By 2023, natural gas breaks above $6. And by 2026, natural gas breaks above $7. Now, this is just a fantasy. It's complete fantasy. When you look at the actual cost of producing shale gas, when you look at the tremendous export market for LNG, I strongly suspect there's just no way whatsoever that it's going to take this long for natural gas to get back to $7 or to $6 or to $5. And any end user of natural gas who is comforting themselves by this relatively slow upward trajectory of natural gas prices as displayed by the forward curve is at the risk of being completely diluted. And again, the point here, the first point, is that forward curve prices are never an accurate forecast of future prices. Never, ever, in my experience, and believe me, I have looked hard to find evidence that even once a forward curve turned out to be a correct forecast of future prices. I have never seen that in any case in any market. They reflect the cost of money. And of course, forward curves, they change from day to day. It's probably a little bit different from when I plotted this out. But my point here is that given LNG export facilities, given the collapse in the rotary rig count and the efforts of the natural gas to minimize production, given the high costs of shale production, and any one of these factors would render this forward curve just completely wrong. All of them make it almost laughable as a prediction for forward prices. So when we go back to this wave count thing, let's see how long did it take natural gas to go from $1 to $16. It took 13 years, and it took it 6 years to fall from 15 back to 2. Well, I don't know how long it's going to take for it to go from 190 to 11, but I know it's going to happen way before 2026. And then there's the whole issue that I don't even treat here of how long is this shale gas likely to last? That's a whole other issue, which I don't really have time to discuss here. It's getting late already. But I want to go into some near-term price technical forecasts here. And I want to bring in at this point, I'm going to be going back and forth between this chart and future source. And here, I just overlay that long-term outlook for that long-term price chart of natural gas, the long-term uptrend support line, with the bullish consensus numbers. And Market Vane, unfortunately, didn't begin its tallying of sentiment in the natural gas market until the year 2000. But right away, you see the swings that you see in any other market. Everybody bullish at the top, everybody bearish at the bottom, bullish at the top, bearish at the bottom, everybody bullish at the top, and probably long, bearish at the bottom, probably short, everybody bullish, everybody bearish, everybody bullish, and at 190.20, everybody was bearish again, to an extreme that had not been seen since $1.76 back in 2001, 2002, where natural gas double bottomed there. And with from the vantage point of history, we all know what happened from 176. Now in wave count terms, one of the reasons I think 190.20 finished the move down from here, A wave down, B wave up, A equals C, bingo. Now let's zoom in to this right here. Here's that 190.20, the A equals C target, the long-term uptrend line from the 102 low in 1992, and the extent, it's interesting, the extent to which this long-term uptrend line was broken, it was broken to the extent of a head and shoulders bottom. This is just wonderful. Left shoulder, head, right shoulder. So this long-term uptrend line was almost the exact neckline of a head and shoulders bottom. And the market has since recovered up to 393.30. Now look where the 618 retracement is of this advance. It's the long-term uptrend line. Isn't that cool? Now, could that line be broken? Yes, but long-term bulls in natural gas don't get in trouble unless this line is broken. And I suspect that as more LNG capacity comes online, the potential for ever seeing these numbers again becomes more and more remote. 618, yeah, that's plausible. And we'll be getting into that in a minute. But first, I have highlighted here $5. Why is $5 important? Because in terms of the bigger picture, it's the 236 retracement of the entire decline from 1578 to 190.20. And the rule of thumb with the 236 retracement is if a rebound after a longer term decline fails to exceed the 236 retracement of that decline, then one can assume that either the longer term trend is still down or the prior low is going to be retested. But you take out that 236 and you can be confident, fairly confident, that the longer term trend is now up. Now, in terms of economics, before we leave the bigger picture, as Chesapeake realized, prices get much below $2, companies start going bankrupt. So I think it's safe to assume that the prior low at 190 is long-term support because, quite simply, producers will go bankrupt at that price. Now there's kind of a common thinking out there, or an urban legend, urban myth, that natural gas will never get over $4 because coal becomes cheaper than natural gas over $4. Well, the problem with that myth is there's about 60 different coal plants scheduled for closure, either because natural gas has gotten cheaper or more because of new EPA regulations. And I think the Northeast just found this out with the kind of Citygate prices they've been paying for the last few weeks. There were a couple of coal plants that used to take up the slack, and they were not able to. So you got some very, very high Citygate prices, which I suspect is a foreshadowing of things to come as more and more of these coal plants decide to shut down themselves. But our concern now is this near-term outlook. Specifically, is there any case for natural gas retesting this long-term uptrend line? Is there any case in the foreseeable future for natural gas getting back down to the 270 area again? Because if there is, it's likely to be a huge long-term buy opportunity. You risk 50 cents, maybe, buy at 270, risk a close below 220 for some real dramatic upside potential, even as only a test of the 236 retracement. So is this even remotely plausible that we might be able to pick up natural gas near 270 anytime soon? Well, I have two wave counts here of the move down off the 393.30 high, which looked very much like a five-wave decline. Excuse me. 1, 2, 3, 4, 5. From 42% bulls to 21% bulls. And since then, the price action looks entirely like some sort of ABC pattern. A wave up, B wave down, C leg up. So the bearish count is that the proposed five-wave decline from 393.30 to 305 was the A wave, and the B wave just ended yesterday at 359.40. A double top into what? Into the 618 retracement of the proposed A wave down, right where a textbook perfect B wave should peak and reverse lower. And not only did natural gas peak in price into the 618 retracement, it peaked into sentiment. 31% bulls at 364.50, 31% bulls at 359.40. Now, you might be saying, well, 39% bulls, that's awful low. Yeah, it's awful low unless you're talking about natural gas. And I want to go back to something here. If I can find it. Yeah, this is what I'm looking for. Since natural gas plummeted from $14 to $2.40 between 2008 and 2009, it has never spent any time above 40% bulls. This was such a traumatic collapse down to only 14% bulls. The sentiment has never been able to recover. Natural gas pretty much tripled in value, but sentiment only edged up from 14% to 36%. The natural gas almost doubled in value again. Sentiment responded by only going from 17 to 38%. And then natural gas doubled in value from here to here. Sentiment only went from 12% to 44%. So pretty much for 5 years now, 40% has been the ceiling. 40% is the new 80% bulls in natural gas sentiment. So if 40% plus or minus is the ceiling, if that's the new 80%, and certainly the history of the last 5 years suggests that it is, well then, if we go back here, this number looks a little bit different to us because it's near the upper limit. It's a bullish 31% is, believe it or not, a bullish sentiment extreme for natural gas. Double top in sentiment and in price into the 618. What does this suggest? Well, if this is our A wave down, A equals C is 271.70. Well, that's pretty cool because 268 is the 618 retracement. And 270 is the new place where the long-term uptrend line is cutting. 618 at 268, long-term uptrend line at 270. A equals C at 271. If natural gas continues to give us the kind of dramatic declines it did today, and already what do we have today now? We have a confirmed doji star top. Big up day, doji star confirmation. So we have a confirmed doji star top into a double top in price and in sentiment into the 618 retracement, suggesting that there is a buy opportunity lurking in the weeks ahead for natural gas. Now, what if we're wrong? What if it didn't peak here? This is our bearish case. What's the bullish case for natural gas? The bullish case I've outlined here, that it peaks not into the 618, but into the 7862 retracement. And it peaks not into the 618 A equals C, but into the A equals C. Still the big A leg down, but here the bullish case is A, B, A equals C into the 7862 retracement. So if you take the average of these two prices, 372 and 374.40, you get 373 as the candidate for the top tick. So if that's where natural gas peaks, then your A equals C is 285 instead of 271. But still, 285 is a whole lot better as a purchase price than 345. Now let's get back to where we were here, because I want to talk about some shifting trends within the seasonal price cycle of natural gas. Our rule of thumb over the last 15 years or so has been to take advantage of this seasonal cycle. Be long, and the big one, especially for end users, has been to be long natural gas from Labor Day into Thanksgiving, where on average the gain in spot contract value has been substantial. Now, of course, not everybody can buy natural gas on Labor Day and store it until Thanksgiving, but even adjusted for the forward curve, even adjusted for the fact that come Labor Day, November and December natural gas is going to be more expensive than October gas, you've never seen this average preseason rally fully discounted in forward prices. And then the next rule of thumb is you're short natural gas from Thanksgiving into St. Patrick's Day, where the average loss has been a 43% drop in spot contract value. Then the next phase, you're long from St. Patrick's Day to Mother's Day, where it's been an average of a 51% gain in value. And then finally, you're short again from Mother's Day into Labor Day, from which this next cycle begins all over again. But there's been some movement within these rules of thumb, especially since shale gas started pouring into storage across North America. High natural gas prices have certainly been one casualty. The ability to spike up to $15 or $20 city gate prices has been a casualty. But another casualty has been the duration of the decline from the Thanksgiving area November seasonal peak. The 23-year average seasonal decline from the Thanksgiving area peak has, if you average the last 23 years, you get the seasonal low following the Thanksgiving peak on February 3rd. You average the last 10 years, you get February 28th. You average the last 5 years, you get March 16th. What's happening here is that the sheer volume, evidently, we think there's a causal connection between this trend and the tsunami of shale gas pouring into the market. So I'm speculating, I'm proposing, my hypothesis is that this shift of a more extended seasonal decline has been because natural gas storage has been so extremely high. How do you bottom out with record high storage levels? You bottom out later. And if not at a lower price, you bottom out later in time. And this is some of the recent numbers of the seasonal cycle lows. Now this year, this was in red was 2012. This is EIA weekly storage report, total storage January to January. Obviously 2012 was a disaster for record storage levels, but 2013 promises to be only slightly better. And this is where we are right now. You look at the projections. These are the projections from Fundamental Analytics. They do great work. This is all other years. So this year promises to be only marginally better in terms of burdensome levels of storage than last year, and still much worse than any other prior year. So in terms of storage levels, there's every reason to believe that this year's seasonal cycle low is also likely to arrive later rather than sooner, as has been the trend for some time now. In fact, last year natural gas didn't bottom until April 20th, 2009, April 27th, 2010, April 1st, 2011, March 4th. Well, we're already past March 4th, and the wave count is saying we still got another major leg down coming, which may in fact have already started. So if we project this out into a first half April seasonal cycle low, that's not an outrageous forecast in terms of this trend of later and later arriving seasonal cycle lows. Now this kind of sums up everything that we've been saying. Here's CH4, natural gas, and this is why I do technical analysis. Who's going to win, the producers' lobby or the manufacturing lobby? Spring is approaching. How much longer is winter going to hang on? Are natural gas shale gas reserves overstated or understated? How quickly will LNG export capacity come online? How successful will natural gas producers be at capping production? These are your bearish influences. These are your bullish influences. and they're constantly battling each other. How do you figure out what's been discounted, what hasn't? Which side is likely to be more successful? Well, with technical analysis, you don't really have to do any of that. You just have to be right about your wave count. You just have to spot the proper patterns, the relevant ratio retracements, the important percentage sentiment numbers, the key wave count resistance points, and the potential downside. Because all of these factors are fully discounted in the price. The price is where all the forces of supply and demand meet. And the theory of technical analysis is that everything you need to know about supply and demand is reflected in the price. Now, again, the purpose of this whole exercise was to give some background into how realistic is it that natural gas prices could rally back to $11 before breaking below $2. In other words, we're taking the component pieces, the biggest, most significant component pieces of the price action, and seeing if there's a case for such a thing, looking at all of these component pieces. Now, the other component piece is the U.S. economy. And this is my last point. I know I've gone on for an hour already, but I'm coming down the home stretch here. The last point is, does the economy matter to natural gas? There used to be a rough relationship. This is spot nat gas, line on monthly close. This is the S&P 500, line on monthly close. And when the stock market took off from 1998, 1999, so did natural gas prices. When the stock market peaked in the internet bubble and stock market prices collapsed, so coincidentally enough did natural gas prices. And when the stock market bottomed and started roaring higher, so did natural gas prices. And when the stock market collapsed, so did natural gas prices. The disconnect occurred when all the shale started showing up. The natural gas was unable to respond to the dramatic move higher in the stock market. Why? Because of the glut of supply. So presumably, because there is a history of natural gas prices shadowing stock market prices, it's reasonable to expect that one of the first things that's likely to happen as soon as the producers get a grip on production again, you're likely to see a relationship restored between the stock market and natural gas prices. But in the meanwhile, there's a disconnect here. And we just don't know when the reconnection may take place. We know that there's actually quite a wildly bullish sentiment excess out there right now, discounting happy days are here again. But I just want to look at a few quick charts here that suggests we may want to restrain from dancing in the street over the fact that the Dow is making new all-time highs. Because adjusted for inflation, the Dow is nowhere near new all-time highs. In fact, adjusted for inflation, the Dow has been in a downtrend since the internet bubble. What are lower lows and lower highs? Lower lows and lower highs is a downtrend channel. So inflation adjusted, there's nothing to celebrate here. And it's going to be a while before the Dow gets anywhere near making a new high in inflation-adjusted terms. And it's the same situation with the S&P. Adjusted for inflation, the peak was the internet bubble. 2007 was a lower high, and we're still well below the 2007 highs. So all this celebrating about the Dow making new highs, people are just fooling themselves, because inflation adjusted, it's absolutely not the case. Now, so do you want to be comforted by a mirage or sobered up by the reality? The reality is there are no new highs out there, and they're unlikely to be anytime soon. But meanwhile, the Dow continues to power higher. It may go a lot higher, yet still, if it's working out a big broadening top pattern, and I'm going to be sending out a special report on this for you Dow followers, hopefully within the week. But what concerns me is the underlying economy, because Fed stimulus is designed to goose the stock market higher. Why? Because a higher stock market, in theory, makes people feel wealthier, and wealthier people who are feeling wealthier go out and spend more and borrow more and stimulate the economy. So that's what the Fed has been trying to do, goose the stock market higher. It's been successful. But what about the fact that the U.S. economy is not based on the 30 Dow stocks or even the 500 S&P 500 stocks? The U.S. economy is based on the consumer. And with tighter credit, there are much more stringent limits on the extent to which the consumer can spend what they don't have. And this is showing that real median household income, adjusted for inflation, peaked with the internet bubble, double topped into 2007, fell like a rock, and has been unable to recover. And the most recent update to this picture just came out last week. The biggest drop in real disposable income in 20 years was the news from the January numbers, wiping out 5 months of inflation-adjusted gains. So the trickle-down effect of the Fed pumping money into the big money center banks, and the big money center banks going out and buying the stock market, and everybody else being forced to, because nobody can live off of Treasury bond income anymore, forcing everybody to buy the stock market, goosing the stock market higher, looking for the wealth effect. The wealth effect of people who own stocks. The average American has a whole lot more money in their home than in their stock portfolio. There's no wealth effect for the average American, especially one who has seen their household income plummet. Now, the flip side of this is economic activity on the consumer level. And this is retail sales corrected by the real inflation, not the inflation that comes out of the government, which is more propaganda than inflation, given the science of hedonics designed to minimize the real inflation numbers. This is the real retail picture, and it's abysmal. It's an I've fallen and can't get up pattern. And the most recent update to this was the fourth quarter GDP. Oh, a typo here. Measly is misspelled. I'll correct that. Up a measly 0.1%. That is a statistical blip. It's basically flat. The diminishing effect of Fed stimulus may have reached the point of no effect. And we've been talking about this for a while, the law of diminishing effect, from continuing to attempt stimulus over and over and over and over again. Eventually, if the economy does not recover, if salaries don't go up, if real disposable income doesn't rebound, then the Fed can pump all at once, and it's not going to improve the consumer level of economic activity that drives our economy. And further evidence of that why is copper breaking down when the Dow is making new all-time highs? Copper is the commodity with a PhD in economics. Why is it not recovering? And just one last chart that I don't have here, my mistake. I believe it's the last page here. I've treated this point before. This is the University of Michigan consumer sentiment numbers, still in a downtrend. Yeah, it was a nice bounce, but look where it peaked, right into the downtrend resistance line. So to summarize, because I'm done here, we have endeavored to explore the case for natural gas making a dramatic rebound in the coming years that virtually nobody publicly seems to be speaking about. But there's more than technical evidence for it. There is fundamental evidence for it, whether we look at the growing case for significant LNG exports or the actual price of producing gas from shale. So I apologize for having gone on so long, but there was a lot I wanted to cover here. Before I sign off and move this recording to our website, any comments, observations, questions on any of this material? Alrighty then. Thank you for putting up with my long-winded exposition here. And if you missed part of it, or some of your colleagues may want to view it, this will be on our website, and you'll be able to view it as a Windows media file from our website. So thank you all, and good night.